Between 90 and 95% of early-stage AI ventures are folding within their first year of operation. By the first quarter of 2026, the artificial intelligence startup ecosystem has entered a period of severe contraction, with a mortality rate that aggressively eclipses historical norms in the tech sector. This chart tracks the timeline of the roughly 14,000 artificial intelligence startups launched globally in 2024. Notice the severe drop-offs. 27% of these companies ceased operations in 2025, and another 13% dissolved by early 2026. That is a 40% absolute failure rate in under 2 years, erasing an estimated $15 billion in venture capital across 11 different industries. The underlying generative AI technology itself remains intact and highly capable. Foundation models continue to scale in processing power, reasoning, and context window size without major interruption. The pathology of this mass failure lies strictly in the prevailing business architecture of the era, the AI wrapper. These companies built thin user interfaces on top of rented intelligence, lacking any proprietary data or infrastructural advantages to protect them. An AI wrapper is an application that calls an existing foundational model's API, packages the output in a polished user interface, and attempts to market that result as an original innovation. During the initial boom of 2023 and 2024, this allowed for incredible speed to market. This split-screen financial model illustrates the structural divergence in unit economics. On the left, a traditional enterprise SaaS application incurs fractional hosting costs per user, allowing gross margins to expand and stabilize between 80 and 90%. On the right, an AI wrapper incurs a tangible compute and inference fee for every single user query. These variable costs scale linearly, often consuming between $5 and $15 per user every month. When we factor in the saturated customer acquisition environment, the math breaks down entirely. The average wrapper spends $180 to acquire a user. Because these tools lack defensibility, users readily abandon them for free alternatives in 4 to 6 months, capping the average lifetime value at $240. This yields a fragile ratio of 1.3 to 1. Established venture capital frameworks dictate that a sustainable subscription business requires a minimum ratio of 3 to 1 to achieve long-term viability. 90% of wrapper entities fail to clear this baseline economic hurdle. In this broken economic structure, user growth does not generate economies of scale. Acquiring even more customers simply accelerates the depletion of corporate cash reserves, driving these companies straight into insolvency. The structural weaknesses of the wrapper model were ultimately laid bare by aggressive feature integration from the foundational model providers themselves. The industry calls this Sherlocking, when a platform owner natively builds a third-party developer's core feature, immediately rendering the specialized application obsolete. The catalyst for the current mass extinction was OpenAI's developer conference in late 2025. OpenAI redesigned the entire artificial intelligence technological stack, releasing native tools like the Agent Kit, which allowed autonomous agents to interact directly with external enterprise applications, and the Apps SDK. These native capabilities instantly achieved feature parity with thousands of niche tools. The foundational model transitioned from a simple text generation utility into a comprehensive service aggregator. Users no longer needed to exit the primary ecosystem to utilize external wrappers. The forensic record of late 2025 is populated with high-profile casualties of this shift. Jasper AI, once valued at $1.5 billion, saw its valuation collapse following native generative text integrations in Microsoft and Google operating systems. Copy.ai, which raised $80 million to automate marketing copy, was forced into a distress merger. If a software product's core utility can be replicated by an independent developer querying a native platform update over a weekend, it possesses zero durable enterprise value. These microeconomic failures are occurring against a backdrop of massive, concentrated infrastructure spending. In 2026, hyperscaler capital expenditures, driven by companies like Microsoft, Google, Amazon, and Meta, are projected to reach $575 billion for data center expansion and advanced silicon procurement. This build-out commoditized the underlying compute layer. Hardware providers like NVIDIA transitioned into the full-stack operating systems of the AI economy. When every enterprise globally has access to the exact same computational toolbox, fine-tuning an open-source model on rented cloud space ceases to be a competitive advantage. This graph tracks the severe downstream margin squeeze caused by the infrastructure boom, using supermicrocomputer as a leading indicator. Notice the violent drop. Gross margins compressed from historical norms of 18% down to a razor-thin 6.4%, explicitly characterized as survival pricing. Despite this margin compression, severe valuation anomalies have emerged within surviving vertical AI sectors. Ambience Healthcare, possessing deep regulatory defensibility, secured a $1.25 billion valuation, translating to a 41 times revenue multiple. In stark contrast, Harvey AI, a platform tailored for the legal sector, commanded an impossible 80 times revenue multiple, despite operating in a market highly vulnerable to disruption. Institutional venture capital firms are underwriting these irrational multiples as a coordinated proxy strategy. By investing heavily in highly capitalized, OpenAI-backed startups like Harvey, they acquire a synthetic call option. This allows them to capture value from an eventual OpenAI initial public offering by indirectly converting their private positions into liquid public stock. The startup application layer is completely trapped. It is ruthlessly squeezed from below by soaring hyperscaler infrastructure costs and manipulated from above by elite financial speculation. The 10% of artificial intelligence startups thriving in 2026 exhibit radically different architectural DNA. They have transitioned away from thin, dependent wrappers toward fat AI, businesses that architect complex ecosystems to own the entire customer outcome end to end. To survive the margin compression inherent in API reliance, founders require deep infrastructure literacy. They optimize internal inference costs by utilizing smaller, open-weight models and deploying targeted database caching mechanisms to aggressively drive down their cost of goods sold. This diagram illustrates the ultimate defense against platform disintermediation, the context moat. This architecture shows a proprietary, domain-specific data loop isolated securely away from an open-source baseline. Foundational labs cannot easily scrape or integrate this data without incurring massive enterprise liability. Surviving vertical startups bypass horizontal competition by embedding deeply into high-friction enterprise workflows. Spellbook integrates directly into Microsoft Word to benchmark real-time transactional law, while Pearl leverages FDA-approved vision models to diagnose dental X-rays. Because they capture unique interaction data within these closed ecosystems, their models improve continuously, distancing the product further from baseline open-source capabilities. Technical capability alone is insufficient. Forensic analysis reveals that up to 85% of enterprise AI pilots fail because they attempt to deploy unmanageable systems that replace human workers entirely, inevitably leading to employee sabotage or project abandonment. The survivors of the 2026 market correction design systems as collaborative coworkers rather than autonomous replacements. They understand true defensibility is forged not in the underlying model itself, but in the messy, high-friction realities of the human workflows it transforms.